Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
It's Chuck, Mike, and Tucker with you, and gotta tell you, we got a full show today, so we're gonna dispense with the pleasantries and get right into it. Starting with yesterday, the United States and Iran inking the Memorandum of Understanding to enter into a 60-day negotiating period on basically a number of outstanding issues that still need to be addressed. I think that ultimately, again, like if you've seen the Memorandum of Understanding, great. If you haven't, that's fine as well. I think ultimately what matters is, hey, what matters to our show, at least in the economic context, what's going to happen to the Strait of Hormuz and what happens to oil production and transit through it. That's what we've been focused on the entire time. Here is what we are seeing overnight. A handful of Saudi Arabian tankers have left the strait and moved into the Gulf of Oman after not doing so during the entirety of the last 3.5, almost 4 months. We are also seeing some tankers from outside the Strait of Hormuz signaling that they want to enter, so you get the ability to fill those new tankers coming in. Beyond that, if you're looking for other positive news, Kuwait, who just 2 weeks ago, on June 3rd, the Kuwait Petroleum Company, a managing director there said, yeah, it's going to take us about 6 to 8 weeks to restore 70% of capacity and probably another month beyond that to get back up to full speed. So you do the math and you say, okay, it's going to be 3 months. Today, The Kuwait CEO, Kuwait Petroleum Company CEO says, yep, we think that we can get back to 70% capacity a week from now. So obviously that would be fantastic news.
Sure.
And the obvious implication is, hey, if Kuwait can, do you think other countries in the Gulf can as well? And if they can, the big thing is this. If they can get back to not full production, but 70% of production by July 1st, rather than by, August 15th, that's an extra 350 million barrels of supply that, otherwise would not have made it to the market. That does a ton to address the potential concerns that are out there because, as the president said yesterday, and Tucker's got some audio of this, so if you could, caw.
If we keep bombing, those ships won't be going. And you're talking about 500, 600, 700 million dollars a day. It's a lot of money. That's why the world is okay. It's liquid. It's fine. Also, we run out of reserves in about 4 weeks. There are reserves all over the world, and we would really run out. And there'll be a time when you wouldn't be able to get it. And you want to see bedlam?
So, look, the president yesterday said what we've been saying on our show for the better part of the last 2 to 3 months. You get to mid-July to early August, and you are up against tank bottoms as far as oil reserves. This is like, we weren't making this up or anything. Like, this is, the president said it yesterday. And again, I think that when you look at this in the context of, okay, why is the deal happening now? It's because this is the time where you had to effectively move. Otherwise, you run into problems. Now, if Kuwait and other countries in the Middle East can ramp up their production as they're now saying, it takes those worst case scenarios off the table, which would be fantastic. Like, then you don't have to worry about, the potential for gas getting to, $5-6 a gallon and stuff like that. And so that would be great. The potential risks that are out there, look, anytime that you're talking about the Middle East, it's a bunch of unreliable actors who don't like each other very much. And, you got to see how things move when the rubber meets the road. But at this point, based on the early signs that we are seeing in the first, call it 24 hours since the memorandum has been signed, maybe for the second time, but it's unclear if it actually was signed the first time or if this is the second. We don't really know.
Sure.
But the first 24 hours here, it does seem like we are seeing positive signs, which does a ton to mitigate those worst case scenarios that were very much on the table, as the president indicated yesterday.
Yeah. So I don't think any of this indicates to us what will occur over the next 60 days. But if you have an ability to move oil, even temporarily, out of the Strait of Hormuz to just resupply the globe with oil, heck, even temporarily, it kicks the worst case scenarios down the road a little bit.
It does. So we'll see how the next 60 days actually play out. I'm hopeful that they go as smoothly as possible and that there is no further economic disruption as a result of this. But these things can take different turns, and hopefully we don't go down those alternative paths where things worsen from here.
The other piece of this that we will be talking about is Iranian oil too, right? You just talked about Kuwaiti oil, but typically Iranian oil for the last, I don't know how long, has only been sold on the black market effectively to these independent Chinese refiners that didn't mind skirting U.S. sanctions. And as part of this, at least initial understanding of the deal, Iranian oil may be able to be sold on,
will be able
to be sold on public markets without sanction, without having to take a, deal from some shadowy Chinese refiner. And that is a new, again, the supply was making its way into the markets anyway, but this is what is Iran, like 5% of the world's oil supply effectively estimated,
3
I think?
to 4, yeah.
That's not an insignificant portion if it does long-term make it into markets.
So this is...
Politics aside, however you feel about that, whether that's good or bad, that is a new set of supply that hits the publicly available oil market.
Yeah, there still are a ton of unanswered questions as it relates to what a longer term deal actually looks like, and just from a geopolitical perspective, you certainly have questions about okay, so, Iran potentially has, wider access to capital markets despite still not really being, still doing many of the things that they've been sanctioned for previously. So you do have some questions as to how this ends up playing out regionally and globally as far as, how, different alignments may shift as a result of this and whether that can hold. But again, first 24 hours as it relates to oil prices and oil flow, some positive, encouraging signs, and we'll take it day by day and week by week over, the course of the summer to see if that continues or if we run into any speed bumps. Let's take a quick break here, and when we return, let's get right to the next big piece of news, which was Kevin Warsh had his first Fed meeting as chair yesterday, and we will discuss takeaways from that.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
This is Susan Powers from the Armstrong Advisory Group. When it comes to Social Security and Medicare, the decisions you make today can have a lasting impact on your retirement. There are key choices to consider, like when to claim, how spousal and survivor options work, and whether your Medicare coverage is aligned with your needs. Without a clear strategy, it's easy to overlook how taxes, income, and healthcare costs all connect. Join us for a complimentary educational seminar on Thursday, June 25th at 5 p.m. at the Marriott in Quincy. We'll help you understand your options and the decisions that come with them. That's Thursday, June 25th at 5 p.m. at the Marriott in Quincy. Reserve your seat today by calling 800-393-4001. That's 800-393-4001 or register online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Estate planning isn't just about writing a will. The right trust can help your family avoid probate, protect your home, reduce estate taxes, and even help shield assets from the cost of long-term care. That's why Cushing & Dolan created a new guide called Demystifying the Top 8 Estate Planning Trusts. Inside, you'll learn the difference between revocable and irrevocable trusts, why some trusts are designed to protect assets from a nursing home, and how certain trusts can keep your family's affairs private. The guide also explains some of the biggest mistakes families make, including creating trusts but never properly funding them. If you've been putting off estate planning, this guide is a great place to start. Call Cushing & Dolan today at 866-848-5699 to get your free copy. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play The Financial Exchange. This is the Financial Exchange Radio Network.
All right, yesterday at 2 p.m., the Federal Reserve released its interest rate decision. And no surprise, they didn't change the federal funds rate in any way, shape, or form. But this was Kevin Warsh's first turn as the chair of the Federal Reserve Open Market Committee, taking over for Jay Powell, who still sits on the committee, by the way, as one of the governors. And here's the deal. This was a really interesting meeting, actually, just with all the different takeaways that you have from it. So, first one, I'm going to kind of go in the order in which everything happened. Fed statement comes out. Fed statement is a lot shorter than the previous ones. You know, the previous ones used to be, they were ranging into like the 5-6 paragraph range. This was like 2.5 pretty quick paragraphs. Just done. This gets at one of the things that Warsh has talked about, which is, hey, I want to do less in the way of forward guidance, telling you what we're thinking about, what's going to happen. And I want the market to do the work for, itself. I don't want us to have to spoon feed you this. We're just going to go about doing our jobs.
Which, by the way, led to some funny interactions between him and the press who, like to ask questions about the Fed.
We'll get there. The second thing then, this was also one of the 4 Fed meetings a year where we get the summary of economic projections, commonly referred to as the dot plot. And the dot plot is basically the Fed's, it's the Fed's, each member puts, a dot in terms of, hey, where do you think GDP is going to be, unemployment, inflation, the Fed funds rate this year, the next 2 years, and long run. Mm-hmm. And so what we did see is that from that dot plot, the Fed expects inflation to be higher this year than they previously guided, core inflation to be higher as well, GDP a touch lower, not too much. We'll get to why that matters in just a little bit, and the unemployment rate they expect to be a little bit lower as well. So basically, what the Fed is signaling here is, we expect there to be more inflation, but unemployment's going to go down, and GDP, real GDP, is not going to be impacted too negatively. The reason being, nominal GDP is growing faster than previously. So what the takeaway then was from the Fed funds rate projections that they gave, hey, they priced in, we're going to have to hike interest rates before the end of the year, and we're going to have to continue to keep rates a little bit higher than we previously thought in 27 and 28. The market interpreted this and said, okay, we have to, reprice what's going on in the bond world, and that's why you saw a bond sell-off take place yesterday. Warsh then came out and gave his press conference at 2:30. By the way, Tucker, did you happen to catch the color of his tie?
That would be blue.
Navy blue, which means that Paul had red, I believe, in the pool.
Yeah, some stupid guess. Yeah.
And I had gold, and Tucker had no tie.
I thought we were going to see Cash Kev.
Tucker had no tie, but sleeves and jacket.
Got it.
Okay. Summer,
Yeah.
So all
for
three
your
of us.
First Fed meeting.
That's right.
Okay.
Listen, forward guidance gone, tie gone could be like an interesting, little juxtaposition there. So Warsh comes out, and again, I think that when we talk about the key takeaways here, number one, very firmly saying, hey, we need to maintain price stability.
Yep.
That was his key focus. I don't think he really mentioned unemployment very much at all.
The only time I heard
conference
was when summarizing the SEP, when he gave out the the dot plot on where members believe unemployment will be a year out, which is exactly where it is now.
He then came out and he said, there's no reason to revisit the 2% inflation target. Great. This is exactly what you want to hear in this first meeting. It's exactly what I said he should say in this first meeting, which is, hey, we've got to focus on price stability, and we're not going to touch the 2% inflation target. It's great. So I think those are the 2 points that I found strongest from him.
I got to be honest, I don't know that I interpreted his comments on the 2% inflation target the same way you did. So he was asked that question about the 2% inflation target.
His direct quote was, I see no reason to visit the 2% inflation target.
He did say that. He also said on the 2% inflation objective, that is the Federal Reserve's long-held objective of 2%. You've heard me say that I tend to focus on the left of the decimal point. Well, to the left of the decimal point, the 2 is left of the decimal point. For now, 0 is to the right. I see no reason until we have reestablished our commitment and ability to deliver on the 2% to revisit that. So I agree that he said we're not going to, but he did leave the door open very much so to revisit in the future, which I found in line with everything else that he said, which is we're leaving the door open to change anything and everything. I interpreted that differently, I guess, is my point.
So other things he said that I liked. He said, look, we're getting rid of forward guidance. Like, we're not going to tell you, exactly how we're going to behave. Like, we're not going to tell you exactly what to expect. We're going to do away with that, and that's not something that we want to do. We've talked on the show, look, I don't need 11 Fed speakers in a given week. I don't need John Williams expounding upon, this and that. I don't need Neil Kashkari telling me everything about this. It's fine. We don't need that.
Agreed, but do you think that that's going to prevent the Fed governors from still giving those speeches? He's doing away with...
the Federal Open Market Committee can absolutely decide when their members speak.
Okay.
They certainly can. The reason that we have so many Fed speakers now is because they send them out in order to communicate.
Yeah.
The place where I think this potentially runs into a little bit of trouble is there is a balance between not giving forward guidance and not understanding what the Fed's reaction function is. And when I say the word reaction function, it sounds, all complicated. It's basically saying, hey, do you understand how they are going to react in different situations? And this is the part that I think is just going to take us some time and is also going to be kind of the prove-it period for Warsh, quite honestly. If Warsh is saying, stop listening to what I'm saying and start looking at what I'm doing, then they're going to have to prove that they can execute competently.
And here's my further problem with that. So he's saying, stop paying attention to what we're saying. At the same time, he laid out a pretty long laundry list of items that they want to change. They want to explore changing the way in which they do things.
This is when we got into I'm doing a task force on this and that.
Exactly. And so I think there leaves the potential for misinterpretation. If you are simultaneously telling the public, we're not going to tell you anything. I know I'm exaggerating. And at the same time telling the general public, we're going to form a bunch of committees to potentially change how we do things, including the communication style. At the same time that inflation has been the number one issue on voters' minds for the last 5 years, I think you have the potential for some mismatched expectations. It's not set in stone, but I think there's a potential for confusion here.
Which I don't think is necessarily bad, but here's what I do think your expectation has to be. For the foreseeable future, call it next 6 to 12 months, I think you need to expect more volatility in rates markets than you did previously because they're going to have to figure this stuff out more on their own and sort through what the new Fed framework actually looks like without Warsh directly telling them. I think that can end either well or badly, depending how the Warsh Fed actually ends up conducting monetary policy.
Yeah.
And so here's the big thing. Warsh is very clearly saying, there was a quote that he had, financial market prices are probably the most important source of information to guide central bankers, but when they are just reflecting back what we said, then we're blind to what's actually happening. And this gets at, Warsh's central belief, in my opinion, which is hey, the markets will tell us what we need to do, but we need to let them operate as markets. Which, by the way, would be a huge departure from how the Fed has operated for the last 20 years. And by the way, a huge departure from how the Trump administration has handled financial markets for the last year and a half as well.
Yeah.
It's been more of a hand-holding process there. So I think we need to see how this plays out. It can play out very well over the next year if the Fed can actually go and execute competent policy in the face of whatever it is they see. If the market judges, hey, your policy is not reflecting what we believe to be appropriate, then it can end quite poorly and the market can end up forcing their hand in a direction that they otherwise wouldn't have needed to go in. Let's take a quick break. We'll wrap this discussion up, and we've got Wall Street Watch when we return.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Without the right estate plan, your family could face unnecessary costs in the future. The right trust may help your loved ones avoid probate and better protect family assets. Get Cushing & Dolan's new guide called Demystifying the Top 8 Estate Planning Trusts by calling 866-848-5699. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive. Most of the time, it's because no one nearby performs CPR. Every walker who joins HeartWalk means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Find your local HeartWalk at heartwalk.org.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One missed retirement deadline could cost you thousands of dollars. Our new guide, Understanding RMDs, breaks down the rules for required minimum distributions, including when you have to take them and what can happen if you get it wrong. This isn't just about taking money out of an account. Your RMDs may affect your tax bracket, the taxation of your Social Security, and even whether you pay higher Medicare premiums. This guide also covers common mistakes people make, like forgetting about old retirement accounts and mishandling inherited IRAs. If you have money in a retirement account, this is information you need to know. Call us right now at 800-393-4001 to get your free copy of Understanding RMDs. That's 800-393-4001, or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Our Senators Edward Markey and Elizabeth Warren and Representative Ayanna Pressley are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today we're talking about your new guide, Todd, Demystifying the Top 7 Estate Planning Trusts. If there are younger families out there, should they consider having a trust in place, and what type?
Most people don't think about it when you're young, but if you're a young family, meaning you've got minor children, you might not have a ton of assets yet, but you want to make sure that what you do have is protected for your children. You could probably use a revocable trust. I don't think you need an irrevocable trust, but a revocable trust. You put your assets in. Again, they're going to avoid probate. Again, it may or may not be a big estate tax issue at the moment, but whatever you have, your children can own, right? They are minors. So you don't necessarily want to leave your assets to a guardian and have the guardian deal with everything when you can design a trust to hold the assets and ensure how and when and where and why they get these assets. Just pick the right trustee, put the language you need in the trust to control it for those children, and the trust will accomplish that task. So just because you're young, folks, doesn't mean you shouldn't think about your estate planning. Sometimes it's not all about the money and the probate and the taxes, but more so about the family behind the estate plan.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they have written a brand new guide called Demystifying the Top 7 Estate Planning Trusts. Call right now for your free copy, 866-848-5699. That's 866-848-5699. Or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets well into the green after President Trump signed the interim peace deal between the U.S. and Iran, sending oil prices lower. Investors also reacting to the first Fed meeting under new chairman Kevin Warsh. Right now, the Dow is up over 0.4%, S&P 500 up over 0.8%, NASDAQ now up 1.1% or 287 points higher. Russell 2000 is up about 0.75%. 10-year Treasury yield down 3 basis points at 4.43%. And oil down over 3.5% lower, trading right around $73 a barrel. Apple CEO Tim Cook told the Wall Street Journal the tech giant plans to raise prices on its products to offset the surging costs of memory and storage chips. However, Cook declined to offer details on the timing or scale of the planned increases, nor which products would be affected. Apple's next major product launch is likely in September when it releases its iPhone 18 lineup. Apple up by 1%. Speaking of Apple, Intel shares are jumping 6% after President Trump said the chipmaker agreed to a deal with Apple to design and build chips in the U.S. Meanwhile, SpaceX shares are falling another 6% today after tapping the brakes on its IPO rally yesterday, where it dropped 5%, and gunmaker Smith & Wesson rallying over 19% after the company posted a 27% jump in revenue in the previous quarter. I'm Tucker Silva, and that is Wall Street Watch.
Mike, anything else that we want to clean up as it relates to the Fed yesterday?
Expectations for a rate hike are up. They've moved up across the Federal Reserve voting members, as well as those who follow markets. That is a departure from where we were at the beginning of this year. It's a departure from where we were even a week ago. The odds of a rate hike at the next meeting are now 30% compared to under 10% 2 days ago. So I think that's the main takeaway here. As we talked about, structurally a lot of execution risk, and the leadership change at the Federal Reserve seems to be pushing for more change at the Fed than we have seen since the Bernanke days. I think I'm comfortable summarizing it that way, that Bernanke changed the Fed permanently in terms of its willingness to take action because of the place they were put in during the financial crisis. I haven't seen much in the way of substantial change there since then, and now you are getting a strong push for substantial change, or at least an openness to change in terms of how the Fed does things, and that could go well, it could go poorly. It kind of depends on execution.
Yeah, we don't know how they're going to do it.
Yep.
Change can go one of three ways. It could go very badly. You could say, okay, we set out to do X and we did not, and in fact we made the situation worse.
Yep.
You could have it be no change at all. Yep, we set out to do X, we did that, but it didn't actually affect the job that we did. okay, we gave it a good try. It didn't help or hurt. Fine. Or your third option is, yep, we set out to do X and we did exactly that, and now it works better.
What's interesting to me is, historically, big change at the Fed has come during times of crisis. 2008, the Fed dramatically expands its responsibility. Volcker in late 70s, early 80s, hikes interest rates to levels that we've never seen before. Why? Because he was trying to stamp out the worst decade of inflation that we've ever seen. And to a lesser extent, Powell dramatically, reshaped what the Fed was willing to do during COVID. They're not turning on a dime here and not making decisions under pressure, but we are talking about some massive changes that the new leadership wants to make to the Fed, and it doesn't seem to be coming at a time of economic crisis.
Not coming at a time of economic crisis, but here's what I will say, is if you take a look at the chart of, let's look at core PCE inflation, because that's what the Fed looks at, is the core PCE price index. And you pull this chart up, and you look at it over the long term, and obviously you went through, the inflation of, thank you, Mark. I don't know why he just chimed in.
Chart. Every time a chart comes up.
Yeah. Okay. Ooh. In any case, we've talked about how the 1990s were a perfectly good decade for the economy, despite not averaging 2% inflation. But the interesting thing is, if you look at core PCE actually spent the entirety from April of 97 through 2000 through January of 2000 under 2%. Core PCE.
Yep.
And that was, again, objectively, probably one of the best, 2, maybe 3 economies of our lifetime.
Agreed.
You then take a look at the 2000s, and core PCE generally stayed under 2% for most of the first half of the 2000s. Not saying it was a good economy, but it stayed under there, and then it, went up above in the latter part of the decade. For the 2010s, core PCE was below 2% for the entire time, which is why the Fed adopted this, approach to, okay, we need to target an average of 2% because they thought inflation actually had been too low in the 2010s. Isn't that kind of a quaint idea now? Here's the problem that we have today is inflation, specifically core PCE, has not been below 2% since March of 2021. Not once.
Right.
Not once. So we're talking 5.25 years now that it's been above. And the other problem that we're seeing, core PCE bottomed in April of 25 at 2.61%, and it's been ratcheting up ever since. Okay, it's at 3.29 right now. And the big reason why core matters, remember, it strips out food and fuel. The idea is that, hey, those things can go up and down. See the last 3 months. But core gives you a better sense of the underlying inflation that tends to be more predictive of where inflation is going to be in the future. And we talked about this last year when, headline inflation data was showing, things were better. It was, hey, headline PCE is down, right around 2.25%. But that was because oil prices were falling. And we said if they, rise, you've got a problem then because of where core is. And so here's the issue that the Warsh Fed is dealing with. Core PCE, it's not like the war in Iran started and core PCE started moving up.
No.
Core PCE started moving up in April of last year and has moved in an uninterrupted fashion on an upward trend. Yes, there were a couple months where, it tapered off a little, but you can look at the chart and you can see the trend line. It's unmistakable. It's moving up and to the right, which is not how you want inflation to move. And so the question that this Fed is now faced with is, hey, based on the data that we have out there, which is, let's look at the totality of the U.S. economy. The labor market,
imbalance.
Still slow. We're still not seeing a ton of turnover.
But balanced.
And actually improving.
Yeah.
The housing market, still slow. But again, you talk about the places that drive it. Florida, Georgia, Texas, the southern part of the country. Those markets are recovering and accelerating now.
Yeah. And so long as we're talking about the Fed, new Fed chair believes that the policy currently is modestly restrictive in the housing market.
Yes. It's kind of tough for me to look at core inflation at 3.33%, and the labor market and housing market improving and say, yeah, inflation's going to be like just fine later this year. It's true. Like, it's not going to show up in headline because that fuel, jump is going to, reverse itself, at least if this move in oil prices holds. But that just means people have more money to spend on the other stuff, which is, again, like in core, and that means that you're going to see more pricing pressure there, especially because then we get to our next piece, which is about Apple. This is a Wall Street Journal exclusive. I don't know why it's... well, I guess Tim Cook said this directly to the Wall Street Journal. That's why it's an exclusive. Quote, unfortunately, price increases are unavoidable. We're doing our best to mitigate the huge increases that are being passed to us, and we've been trying to shield our customers from the increases, but the situation has become unsustainable. So Tim Cook taking one for the team because, remember, Cook's on his way out. Yeah. He's retiring. I still don't know what the name of the new... John Turnus, that's his name. So he's taking one for John Turnus, so Turnus doesn't have to be the bearer of bad news on this. But the same problem that is pushing up memory chip prices for, AI companies and everyone else in the computer space, Apple's not immune to it just because they're Apple. They still are dealing with having to outcompete other people for the orders for chips as well. And so Apple, you look at some of the projections here. The Wall Street Journal did a projection on this, and in order for Apple to maintain profit margins, they probably got to raise iPhone prices by somewhere around 17 to 18%.
$270 additional cost to the iPhone Pro model would maintain their margins, according to Tech Insights.
So, again, this is inflation that is very much not food and fuel related.
And it's not measured yet.
It's in fact related to the very thing that's causing growth in the U.S., and so this is the piece that we talk about when we talk about the dangers of running an economy too hot, is if you produce too much demand for the level of supply that's out there, you can run into this kind of stuff.
I'll also point out that a key area of disinflation for the last 3 decades has come from stuff like the iPhone.
Yes.
It's come from televisions, computers, products that have gotten better at doing what they do while also becoming cheaper. If that reverses itself, a year ago I thought it would have reversed itself due to tariffs. Now we're talking about it reversing itself from something else entirely. But in either case,
organic demand. But yeah,
if it reverses itself, you really have to see some give from somewhere else in the basket of goods, and I plainly just don't see where you get that.
So this is going to be the interesting mix that we need to sort through in the second half of the year. And markets are going to be watching, hey, what does this Fed do, and are they actually going to respond the way that Warsh indicated? Because here's where the credibility of the Fed's going to be put to the test. Warsh, in no uncertain terms yesterday, said, we will deliver price stability. Like, his quote was simple. This committee will deliver price stability. I put it in bold in my notes because... well, it's like he said it like 4 times in the first 5 minutes. So the question is going to be, if you are faced with core PCE inflation rising to basically in line with the Fed funds rate, Fed funds is 3.5% to 3.25% right now. All you need is another 0.2% on core PCE, and you're there. If you're faced with that and you still say, no, we're not going to do anything,
you lose all credibility.
Then you've got a credibility problem because you told us to judge you by your actions, not your words, and so you lose the credibility problem. If you don't see core PCE move up and instead it moves down, they're not going to be faced with that. And if it moves up and they decide to raise rates, then they have credibility. But this is going to be what we watch over the next 6 to 12 months, and we'll see how good of a job the Warsh Fed actually does. It could be good, it could be bad, it could be anywhere in between. Keep an open mind on these things. We say this all the time. Consider all of the possibilities, and then you won't be surprised by what happens, and you can adapt your view as you get more information. Let's take a quick break. When we return, let's see. We talked about Apple. Let's talk about Intel, because they have some Apple news as well, maybe, and we'll discuss that next.
Remember, you can watch the show live every day on our YouTube page. We've got market updates and breaking business news all morning long, plus a full archive of all our show's content. It's all there with the click of a button at youtube.com/The Financial Exchange Show. Without the right estate plan, your family could face unnecessary costs in the future. The right trust may help your loved ones avoid probate and better protect family assets. Get Cushing & Dolan's new guide called Demystifying the Top 8 Estate Planning Trusts by calling 866-848-5699. That's 866-848-5699. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. For veterans, every day is a commitment to service. This Veterans Day weekend, be part of something meaningful at the DAV 5K Boston. Join the thousands of runners and walkers at Fort Independence on Castle Island for a day of community, remembrance, and gratitude. Proceeds help fund the programs and services provided by the Disabled American Veterans Department of Massachusetts. To register or make a donation, please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck from the Armstrong Advisory Group. Our new guide, Understanding RMDs, explains why required minimum distributions are about more than just withdrawing money from a retirement account. The rules can get complicated fast. An inherited IRA opens up an entirely new set of deadlines with rules to follow, and mistakes can be costly. The IRS can impose a penalty of up to 25% of the amount that should have been distributed. But there also may be opportunities to plan ahead. The guide covers strategies like qualified charitable distributions, reinvesting RMDs, and ways to help manage future tax exposure. To request your free copy, call us today at 800-393-4001. That's 800-393-4001, or request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Is it a stroke? Even if you're not sure, act fast and call 911. Signs can include face drooping on one side, arm weakness, speech difficulty, or not making sense when talking. Time is critical. A stroke requires immediate medical care, which starts as soon as the ambulance arrives. So if you see any sign of stroke, act fast and call 911. Visit mass.gov/stroke, sponsored by the Massachusetts Department of Public Health.
Breaking business and financial news first throughout the day. Only here on the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Register for this year's DAV 5K on Saturday, November 7th at Fort Independence on Castle Island. If you're not able to participate, you can still support our great American heroes by visiting dav5k.boston and making a donation today. Your participation helps provide vital services like free transportation to medical appointments and safe housing for single veterans and their families. Donate today at dav5k.boston. That's dav5k.boston.
Let's see. Bloomberg piece here. Intel soars after Trump says it struck Apple chip deal. So, interesting in that we're now getting deals announced by the president rather than by the companies.
One of the largest shareholders.
Which, again, this is if you are trying to build a competitor to Intel,
you're screwed. Don't bother.
You can't.
Yeah.
Like you have like the executive branch is saying no. Like this is the horse that we're running with.
Yeah.
And look, I've said for a while I want Intel to be able to be a viable competitor in the field. Certainly being able to, expand additional partnerships and then deliver on those partnerships is fantastic if they're able to do so. But one of the problems that we have in a number of industries is that you already have kind of this idea of, these national champion companies where they're not owned by the U.S. government, but they've become so consolidated in their field that you don't really have any viable competition anyways. This is just moving further in that fashion here. And I don't know that it's great for, long-term sustainability. Or, hey, what happens if Intel can't deliver on their promises as they haven't been able to for the last, decade or so? Now you've put all this money into a company that hasn't been able to deliver, and there are no alternatives because no one wants to fight against the company backed by the U.S. government.
Yeah. I don't know. I believe as of the announcement, neither Intel nor Apple confirmed the deal. I don't know if they have since then. So, still some open questions there. But, I mean, broadly speaking, what I'll say is that when the state decides who the winners and losers are, we all lose. Like, that's not how you want this to work. And to your point, Chuck, we see it with all sorts of companies globally. Like, you can look at communist Russia for examples of this. You can look at companies like Boeing. Does anybody look at Boeing over the course of the path that they have taken over the last 30 years and say, what a beaming success? What a success story of American industry. No, they were the best at what they did in the world 30 years ago and then failed to innovate, plagued by corruption, and led to some of the worst disasters we've seen in flight history over the course of the last decade. Like, I am vastly uncomfortable with the idea that the U.S. federal government is now in the business of picking winners and losers.
And look, those of you listening might say, hey, like, it's fine. Like, I trust the president to make these deals. That's okay, but the president's not always going to be the president. So I say the same thing that I always say. Imagine the least qualified politician that you can think of. And now imagine them sitting in the White House 4 years, 8 years, 12 years, however many years out from now. Imagine that person in the White House. Do you want them to have the power to, facilitate deals where the U.S. government is taking ownership and starting to direct how companies operate?
Because, by the way, they now have that.
Right, like
Congress didn't authorize this money.
So that's how I always look at it, is like, think about the least qualified person in any position, and then you build that position based around the controls that you would want to impose on them from doing things.
Am I wrong about that, by the way? Did Congress authorize the spending on Intel shares?
I don't know. I don't know offhand. So, in any case, this is where we are on this. We'll see. I would imagine that.
So they reallocated money that was set aside as grants under the CHIPS Act to take an equity stake in Intel. So
there you go.
Yeah, there you go.
So in any case, we'll see. I'm not sure, but again, we'll see what kind of deal actually comes to fruition between Apple and Intel here. And let's take a quick break. And when we return, we got hour 2 coming up.
I was 24 when I had a stroke. I was 35 when I suffered a heart attack.
I was 46.
I was 62.
It's a fact. Cardiovascular disease is the leading cause of death in women.
But we can fight against our #1 killer.
Talk to your doctor about your risk factors.
Know your family history.
Learn the warning signs and symptoms.
Together,
let's go red for women.
Visit goredforwomen.org to learn more.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Without the right estate plan, your family could face unnecessary costs in the future. The right trust may help your loved ones avoid probate and better protect family assets. Get Cushing & Dolan's new guide called Demystifying the Top 8 Estate Planning Trusts by calling 866-848-5699. That's 866-848-5699. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM, Concord, Boston. The Money Matters Radio Network. Every mile can make a difference for a Massachusetts veteran. The DAV 5K Boston returns to Castle Island on Saturday, November 7th for a family-friendly day of community, remembrance, and support. Whether you run the 5K, join the 1 mile walk, or make a donation, your participation helps further the mission of the Disabled American Veterans Department of Massachusetts. Honor those who served. Sign up today at dav5k.boston. That's dav5k.boston.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
A trust can do a lot more than simply pass assets to your family. Certain trusts may help keep your estate out of probate, protect assets for your children, and in some cases, even help reduce estate tax liability. Cushing & Dolan has created a new guide called Demystifying the Top Estate Planning Trusts. It breaks down some of the most commonly used trusts in estate planning, including trusts designed to help families plan for long-term care, protect beneficiaries with special needs, and help keep life insurance proceeds outside of a taxable estate. You'll also learn why simply having a trust isn't enough, because if it isn't properly funded, it may not accomplish the goals you expect. To get your free copy, call Cushing & Dolan today at 866-848-5699. That's 866-848-5699 or request the guide online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive. Most of the time, it's because no one nearby performs CPR. Every walker who joins HeartWalk means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Find your local HeartWalk at heartwalk.org.
Hi, this is Chuck and Mike from the Armstrong Advisory Group. We've got a guide available this month on required minimum distributions. And, Mike, I want to talk about common mistakes that we see. Sure. Let's start first. People not understanding the difference between inherited and non-inherited IRAs.
Yeah, so if you've ever inherited an account that is retirement in nature, you've dealt with these complicated rules. And to make it more complicated, the rules have changed over the last several years. But suffice to say, unless you meet some very specific scenarios, in most cases, if you inherited an account from a non-spouse, then you're going to have 10 years to empty that account, pay any of the taxes that are due on it, and move along. But in addition, there are annual required minimum distributions, and it is very complicated.
What about a situation where someone tries to delay taking their RMD? What kind of problems can you run into there?
Well, one, if you delay your first year RMD, then you're going to have to take 2 in the same year, and that can really add to the tax burden. But more generally, if you just wait to deal with your future RMDs until you're 73 or 75 years old, you just have fewer options. It's going to bump up your income. You may end up paying higher taxes. You may end up paying higher Medicare premiums. Your Social Security could become more taxable. So it pays to plan early when it comes to RMDs.
Our guide this month is titled Understanding RMDs, and there are 2 different ways you can request it. The first, you can go to armstrongadvisory.com and request it there. The second, call 800-393-4001. That number again is 800-393-4001, or request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you here, and on the back of the signing of the Memorandum of Understanding between the United States and Iran and Kevin Warsh's first meeting as Fed chair. Yesterday left us with some downward volatility. Today, the good news, we got the upward kind. The bad news is we still have volatility. You like to see markets calming down. Instead, they're still kind of jumping around as they have for the last couple weeks right now. to be honest. You take a look at where the S&P 500 has been over the last couple weeks, and it's been, okay, like 4% dip down, 3% move up, 2% move down. It's not really a stable equilibrium that you have. It's kind of chopping around trying to figure out what the new world looks like in terms of, hey, what's the Middle East going to look like? What's the Fed going to look like? Kind of hard to find, two more meaningful potential drivers of the global economy than those two topics. And so that's why it's not surprising that you got a little bit of volatility in the system. As I noted today, it's the good kind, to the upside. 75 points up on the S&P 500, 235 on the Dow, and 359 on the NASDAQ. So anywhere from about a 0.5 to 1.3% move up in your major indices. 10-year Treasury, after selling off yesterday, coming back down a little bit, down 3.7 basis points to 4.426. Dollar index still strengthening right now, up another 0.49% to 100.355. That is dragging gold to the tune of $114 down at $42.67 right now. And crude oil continuing its slide as well, down $2.69 a barrel to $74.10 on West Texas Intermediate. AAA national average for gas prices. Have I got news for you? We are now seeing the AAA national average at $3.99 and 9/10, back below $4 a gallon here. First time in a couple months that we've seen that be the case. Based on where we are seeing oil priced right now, you probably got some room to get down into that 360 range, so another 35-40 cents to go once this kicks in over the next couple of weeks here. Obviously, this can all change depending on where crude goes in the near future. I don't think there's too much more room for it to run down in the short term, but we'll see how things move. And obviously, if things flare up in the Middle East at some point, that could raise some questions about the stability of the deal that's been signed. But first 24 hours, things look pretty good. We've got ships flowing through Hormuz. Lower quantities than we'd like to see, but higher than they've been, so you got to start somewhere. And countries indicating that they're starting to ramp production back up or planning to in the near future. Piece in the Wall Street Journal, turbocharged earnings are pushing stocks higher. But there's a catch. Michael, what's the catch?
The catch is that accounting makes how this money is being spent and realized on company balance sheets and P&Ls a little bit tricky.
You mean that they're going to start talking about the depreciation thing that we've been talking about for the last 9 months?
That's the one. Yeah,
I love when you can listen to our show 9 months in advance of what the Wall Street Journal publishes.
So let's make this really simple with an example.
I'm a shrimp boat captain.
No, let's just talk about a data center. Let's talk about a data center.
I am
builder.
Chuck AI.
Yeah, you're Chuck AI, and you decide to buy $5 million worth of chips from NVIDIA, and you somehow get them.
Got them.
What happens
in my data center?
What happens in that case? You would think, right? $5 million expense on Chuck's side, $5 million of revenue to NVIDIA. So one offsets the other in terms of the gross, market and measuring of companies' P&Ls. That's not what happens. What happens is that NVIDIA does get to book the revenue immediately.
Assuming that they delivered it immediately.
Yep. If they deliver it, they get to book the revenue. On Chuck AI's side of things, I'm going to oversimplify this and probably explain it poorly. It's not a P&L item. They are making a purchase of an asset. And they get to depreciate that asset over a period of time and then book some of the expenses over time as an accounting item.
Generally, it's over its useful life, which let's estimate at 5 years, so I get $1 million of depreciation a year that I book.
So even though Chuck did depart with $5 million right up front, according to his company's P&L, it's not realized that way.
No.
And so what
my
you
cash
have,
flow statement shows it because it goes out there, but it shows up differently on the income statement.
And so what you have across the market right now is a bunch of companies paying for things like chips and other things that go into artificial intelligence. They're paying for it up front, oftentimes with loans, sometimes with equity, all different ways of doing so. The companies that are selling the stuff are booking revenue immediately. The companies that are buying the stuff are not booking expenses immediately. It makes everybody look very pretty.
And we've talked about this where, look, if you're building the sheer volume of data centers that are being built right now, there's a lot of depreciation that is in the pipeline. So again, just looking at some of the numbers that we have in terms of, the updated amounts of build out that are happening here, we're talking, somewhere in the ballpark of this year, probably high 700, low 800 billion dollar range, and then the next several years, like $1 trillion in capex between Microsoft, Amazon, Google, Meta, and Oracle.
Right.
So here's the deal. The estimated useful life of a data center, first of all, it's not as simple as that. Like, each component has, like, different useful lives. But if you look at what these companies are generally using, it's anywhere between, like, 6 and 8 years. So what that means is if you have $800 billion in capex happening this year, that build-out, you're now going to have $100 billion in depreciation for the next 8 years that you've got to cycle through. Mm-hmm. Then you've got next year's $1 trillion. Now you get another $125 billion a year on top of that. So it keeps adding up. And where you get to very quickly, and this is the place that we've talked about, hey, this is all well and good until your depreciation starts making your earnings look bad because your earnings aren't growing as quickly. And so you need to grow. Remember, every unit of revenue that you bring in has costs associated with it as well. The operations, marketing, like this, there's plenty of stuff that's out there. And so the place that you get to pretty quickly is that you need revenue to ramp up by not just like, great, Anthropic's doing, $40 billion annual run rate. No, you need the whole industry to start doing like $2 to $3 trillion annually in AI-related revenue. Otherwise, the math just doesn't make sense as you continue to go out there. And this is the problem that you're going to run into, which is, look, these companies in trying to be profitable, they're shifting to usage-based pricing, which means that you have to pay through the nose in order to actually use the stuff, which means then companies start saying, hey, maybe we shouldn't rank our employees based on how much AI they're using as a positive, but instead we got to figure out how to ration it based on who's getting the most bang for their buck out of that use. And so then does the revenue grow as quickly as it was growing before? It's a real chicken and egg catch-22 type problem.
Yeah, and by the way, this is not hypothetical. The usage piece.
This is happening now.
Right. The piece that hadn't happened until recently. Like the accounting stuff, we brought that up a year ago. Like that's been...
We said that it was going to become a problem in future years.
Right. What's happening now that wasn't happening previously is that companies are actually beginning to care about the costs associated with using AI. Not saying they didn't care about other costs related to AI before, but the idea of Uber or Salesforce or any of these companies that
Meta
are utilizing artificial intelligence to develop products, increase their employee efficiency, actually caring about the input costs for going into it is a new phenomenon. They did not care until recently because the costs weren't that big until recently. And all of a sudden, you have the stories like Uber coming out and saying, oh, yeah, we blew through our entire annual AI budget over the course of 4 months. Should tell you something about where this could go.
So the place to watch is over the next couple of years and what these big hyperscalers do as those depreciation costs start to come home to roost. Because it's one of two things. Find the revenue to make it make sense, or start cutting that capex. Those are your two options. You can't just keep building $1 trillion in data centers every year forever. That's not really an option if you don't have the revenue coming in. So one of two things needs to happen. The revenue's got to jump by a ton, or you got to start cutting that capex. You hope for the former, and you deal with the latter if that's what it ends up being. But this is the state of play. And this is the next, by the end of 27, we're going to have the outcome on this. Because they're going to have to make the CapEx decisions for 28 and 29 then. So there's an 18-month period where we're going to have to see how this works out, and then we're going to know. I hate when we have these ticking clocks. It's like we just finished the Hormuz clock, and now we've got this one.
Yeah.
I feel like I'm on like an episode of 24.
But you know what? As I've said, I think I said this earlier this week, this market feels to me as though it is the most execution-dependent market that we have ever seen. At least since I've been investing.
I'm trying to think about that. Like,
there's no way to measure it and compare it, Chuck. There really is.
There's no way to measure, but what we're going to do, we're going to take a break. And when we come back, we're going to do some trivia, because we've got that. But then I'm going to spend the break thinking and ruminating and meditating on what you just said.
You don't have much time to meditate. That usually takes a little bit more time.
Oh, not for me. I'm a professional. Okay. Don't worry about it. Let's take a quick
6-second
break.
meditations. Yeah,
and when we return, we'll talk about execution-dependent markets.
Subscribe now to our YouTube page, where you'll find daily interviews and full shows of the Financial Exchange. We'll get you caught up on anything and everything you might have missed, right here on the Financial Exchange.
This is Susan Powers from the Armstrong Advisory Group. When it comes to Social Security and Medicare, the decisions you make today can have a lasting impact on your retirement. There are key choices to consider, like when to claim, how spousal and survivor options work, and whether your Medicare coverage is aligned with your needs. Without a clear strategy, it's easy to overlook how taxes, income, and healthcare costs all connect. Join us for a complimentary educational seminar on Thursday, June 25th at 5 p.m. at the Marriott in Quincy. We'll help you understand your options and the decisions that come with them. That's Thursday, June 25th at 5 p.m. at the Marriott in Quincy. Reserve your seat today by calling 800-393-4001. That's 800-393-4001, or register online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Estate planning isn't just about writing a will. The right trust can help your family avoid probate, protect your home, reduce estate taxes, and even help shield assets from the cost of long-term care. That's why Cushing & Dolan created a new guide called Demystifying the Top 8 Estate Planning Trusts. Inside, you'll learn the difference between revocable and irrevocable trusts, why some trusts are designed to protect assets from a nursing home, and how certain trusts can keep your family's affairs private. The guide also explains some of the biggest mistakes families make, including creating trusts but never properly funding them. If you've been putting off estate planning, this guide is a great place to start. Call Cushing & Dolan today at 866-848-5699 to get your free copy. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
From market moves to retirement planning strategy, follow the Financial Exchange on Instagram and stay up to date on the business news of the day. This is the Financial Exchange Radio Network.
All right, time for trivia here on the Financial Exchange, and today is Paul McCartney's 84th birthday. After the Beatles broke up in 1970, McCartney formed a new band that became one of the most successful acts of the 70s. So our trivia question today is simply, what was the name of Paul McCartney's first band after the Beatles? Once again, what was the name of Paul McCartney's first band after the Beatles? Be the ninth person today to text us at 617-362-1385 with the correct answer, along with keyword trivia, and you'll win a Financial Exchange Show t-shirt. Once again, the ninth correct response to text us to the number 617-362-1385 with the correct answer, along with keyword trivia. We'll win that t-shirt. See complete contest rules at financialexchangeshow.com.
All right, so I was doing some thinking during the break. Mike had called this the most execution-dependent market that we've seen. And how would you define that, I guess?
I guess my point would be that companies are spending a previously rare amount of their profits on capital expenditures, and so therefore you need to realize the profit. And I was trying to find a way of measuring that, and I couldn't do it in the 5-minute break, but I'm thinking like there's got to be a way to measure S&P 500 CapEx as a percentage of sales, or S&P 500 or general capital expenditures as a percentage of GDP, and to look at it that way. And that's my sense, but I don't have any firm charts or data to be able to back up that right now is an elevated level of CapEx compared to some other historical norm.
Well, let's think about our CapEx-intensive businesses. Airlines.
Sure.
Do they typically command any kind of premium?
No.
Car companies. Do they typically command any kind of premium?
Only one of them.
Computer hardware manufacturers. Do they typically command any kind of premium?
Generally, no.
Clothing companies. Do they tend to command any kind of premium?
Rarely.
Guys, if you got to spend a lot of capital to build stuff, your businesses have generally been hated for the last 20 to 30 years. Because profit growth has been in the companies where, hey, you don't have to spend. Does anyone like mining companies right now? I'm not saying that they're not useful. You need, copper and you need nickel. But does anyone wake up in the morning, aside from the people who really love pain, and say, yes, let me dig into the miners today? No, everyone's no. Investors have loved the CapEx light businesses, which, by the way, have been the growth engine in, recent history. Talking about, again, they get lumped into tech. They're not really tech companies. They're just CapEx light companies. Netflix. Again, people love that. Microsoft, Apple. These are not companies that spend a bunch of money on CapEx. Even Apple. Does Apple build any of their own stuff? Nope. A tiny little fraction of it they build. The rest of it, nope. We found a contractor somewhere else who's going to build it. Go try to find an Apple factory. You can't. They don't really exist aside from a few niche products that they do make themselves. But the iPhones, they're made by Foxconn over in India or over in China or over in Vietnam. Same with iPad. It's what they do. They don't do the CapEx build out. They're no, someone else do that for us. Even the hardware companies that are successful don't do it themselves. They're no, someone else do this, please. So you look at it, and the big question is, hey, the two of the companies two of the types of companies that we're talking about. One is computer hardware manufacturers. Well, that's exactly what's been the big driver of this between NVIDIA and Broadcom and Micron and AMD and the whole list of them. Do we really think this is going to be the one time when computer hardware companies don't have to sink all of their profits back into just building more stuff when that cycle is in the cycle then rolls over as they expand capacity right into the end of the cycle? No, it's not you're not going to just have a permanent upward slope on the line. It's not how any of this works. Likewise, the companies that people still love, in kind of the software space, the Microsofts of the world. Well, they're pouring all this CapEx in too. Can they actually make any money off it? The reason why investors loved Microsoft was because you had to pay X dollars a month for access to Microsoft Word now, and there's not really much that Microsoft had to do in order to maintain that. The margins were fat. Well, now if you've got like new Clippy running around trying to help you out with, your spreadsheets and this and that, new Clippy's a little bit expensive to operate.
Mm-hmm.
And can you actually make the money off that, or do you have to, figure out how to make it work? So I don't know. I look at this, and when it comes to, hey, this is like the most, execution specific time for at least like the market cap that we're talking about. Yes, there's always been companies that have to spend a bunch of money and then execute their way through it. They haven't really been in the driver's seat for the last 20 years by and large.
True.
It hasn't been like mining companies and energy companies and airlines and car companies driving the ship at the S&P. Hasn't always been tech. Again, the tech phenomenon is more recent. I know it feels like forever. But, yeah, it's more dangerous because typically when you start spending a lot on CapEx, the market says, no, we don't like that. And right now the market's saying, no, I do like that. The more you spend on CapEx, the more I'm going to reward you. At some point, that mechanism usually breaks. I don't know if we're a month from that, a year from that, or 10 years from that. And that's the ballgame. Like, that's the whole thing. Let's take a quick break as we head towards the bottom of the hour. Stocks remain broadly positive. All major indices up anywhere from a third to about 1.25%. Quick break here. When we come back, we've got the trivia answer and Wall Street Watch.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Is it a stroke? Even if you're not sure, act fast and call 911. Signs can include face drooping on one side, arm weakness, speech difficulty, or not making sense when talking. Time is critical. A stroke requires immediate medical care, which starts as soon as the ambulance arrives. So if you see any sign of stroke, act fast and call 911. Visit mass.gov/stroke, sponsored by the Massachusetts Department of Public Health.
Our Senators Edward Markey and Elizabeth Warren and Representative James McGovern are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. As you age, the IRS stops asking you to save for retirement and starts insisting that you take money out. Those withdrawals are called required minimum distributions, and if you don't take enough, you could face a penalty of up to 25% of the amount you were supposed to withdraw. If you wait too long to take the first distribution, you could end up with 2 taxable withdrawals in the same year, which might push you into a higher tax bracket or increase your Medicare premiums. Our new guide, Understanding RMDs, covers this issue and others to help you prepare for this important retirement deadline. Get yours today by calling 800-393-4001. That number again is 800-393-4001, or you can request the guide from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local Heart Walk. Extraordinary starts with you. Join Heart Walk today. Find your local Heart Walk at heartwalk.org.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about your new guide, Todd, demystifying the top 7 estate planning trusts. Now, do you lose control if you transfer your assets to an irrevocable trust in order to protect them from long-term care expenses?
Well, that's great when you mention that irrevocable trust, but limit it to the kind of trust where you're protecting it from the cost of long-term care. Because as the guide says, there's 7 different kinds of trusts that we're trying to demystify. And there's also many kinds of irrevocable trusts out there, not just one type. So many people think there's just one type. But this particular type, where you're trying to protect it from the cost of long-term care expenses, the answer is no. You do not lose control over your assets. There's a whole spectrum of control with irrevocable trusts. And this one, you keep about 95% control. Like, you can live in your house, you can sell your house, you can buy another house, you can invest your money, you can manage your money, you can collect the income. Even the tax liability of these trusts are designed to be at your own rate. In other words, they are grantor trusts. You don't even pay any higher income taxes when you have this irrevocable trust. So this kind of trust, folks, you keep control and you protect your assets from the cost of long-term care.
Call right now for your free copy of Cushing & Dolan's comprehensive guide titled Demystifying the Top 7 Estate Planning Trusts. It will help you determine what type of trust is right for you and your family. Call 866-848-5699. That's 866-848-5699. Or you can request it from LegalExchangeShow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today. Right here on the Financial Exchange Radio Network.
Markets are trading higher after President Trump signed the interim peace deal between the U.S. and Iran, sending oil prices lower. Traders also reacting to the first Fed meeting under new chairman Kevin Warsh. Right now, the Dow is up about 0.3%, S&P 500 up 0.9%, NASDAQ up 1.1% or 309 points higher. Russell 2000 is up nearly 1.5%. 10-year Treasury yield down 2 basis points at 4.43%. And oil down nearly 4%, trading right around $73 a barrel. Apple CEO Tim Cook told the Wall Street Journal the tech giant plans to raise prices on its products to offset the surging costs of memory and storage chips. However, Cook declined to offer details on the timing or scale of the planned price increases, nor which products would be affected. Apple stock is up modestly. Speaking of Apple, Intel shares are jumping 9% after President Trump said the chipmaker agreed to a deal with Apple to design and build chips in the U.S. According to Bloomberg, Amazon is in talks to sell its custom-made AI chips for use in other companies' data centers, a key expansion of its efforts to cut into NVIDIA's dominance. Amazon up over 2%, and SpaceX shares now falling another 8% after tapping the brakes on its recent IPO rally, where it shed 5% yesterday. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question. What was the name of Paul McCartney's first band after the Beatles? That would be Wings. And Brian in Methuen, Mass. is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Brian. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Only a week left here before an event that we are hosting, so I want to make sure everyone's aware of it. I've talked about it a couple times here, but June 25th in Quincy, Armstrong Advisory Group is hosting an entire session on learning about Social Security and Medicare. These are programs that just about every retiree will find crucial to their overall retirement picture, and the programs have changed a lot over the years. There's a lot of in and outs that you really do need to know if you are looking at retirement in the not-so-distant future. It is free to register. There are still a few spots left. You can go to armstrongadvisory.com/events. Like I said, free to attend, 5 p.m. a week from today, June 25th in the Quincy Marriott. You can register at armstrongadvisory.com/events. You can call 800-393-4001. But again, armstrongadvisory.com/events for your free opportunity to attend our Social Security and Medicare Essentials info session seminar down in Quincy a week from now.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Piece from the New York Times: retail investors help send SpaceX soaring. Does that mean that they helped send it falling the last 2 days? I mean, like,
yes, it does.
I can't stand when we have to like write the narrative of what a stock is after less than a full week of trading, because here's the deal. Stock IPO'd last week. The first trades that we had were around $150 a share. It went up to $225, so that's a 50% rise even if you bought it at that $150. It subsequently now has fallen from $225 down to $176, which is a 22% drop from its peak on Tuesday.
Just like exactly what we warned people of.
Again, like I don't know. I freaking love to say I told you so, because I told you so. Like, IPOs are highly volatile instruments, and they might do great over long periods of time. They might do terrible. But one thing that you know is coming is volatility, and this is now a 22% drawdown in a span of 2 days. So if the New York Times is going to say, hey, retail investors help send SpaceX shares soaring, well, then are those same retail investors helping it to suck the last 2 days? I don't think any of this means anything. The stock is going to do how it does over whatever, extended period of time without this first day or two being a judgment on how the company is. I don't think it's great just because it had a good first 3 days. I don't think it sucks just because it had a bad last 2. It's just a new IPO doing new IPO things.
A few things that I just want to one main thing that I want to bring up. We already covered how, newly public companies oftentimes are quite volatile. In the, last 5 years, all sorts of new financial products have made their way into markets, that some for better, some for worse. It really depends on how you use them. But for anyone out there that doesn't typically read those prospectuses that they get from investments that they make, if you're considering any of these 2 times long single stock ETFs or any of those really complicated new financial products that have made their way out there that are all over the place, I would really, really encourage you to spend some time actually understanding what it is you're investing in. It is complicated enough to go and own an individual stock. When you talk about owning an ETF that mirrors the stock with leverage or attempts to, you are getting into a whole different ballgame that you may not fully understand. I barely fully understand it. And so just a word of caution out there, because these things did not exist a decade ago.
No. Let's see. What else do I want to get to here? Oh, let's cover a little bit of housing, if we could, just briefly. Why so many Americans can't afford housing anymore. There's a whole piece in USA Today on this. And it goes through this report titled The State of the Nation's Housing, that was produced by Harvard University's Joint Center for Housing Studies. Bunch of nerds, but really good nerds. And here's the deal, is that basically they say pretty much what we have talked about. We are not building enough homes, and so you end up with housing prices being out of reach because incomes are too low to support homes at these prices for the level of demand that is out there.
Yeah, this is all fair, reasonable, and true, but I'm going to disagree with the title of the article and the premise of it for a moment here. So many Americans can't afford housing anymore. The rate of homeownership in the United States is sitting at 65.3%, according to the St. Louis Fed.
Which is fine.
We have been above that, right? Like in Q2 of 2020, that bumped up to 68%. in pretty much the entire period surrounding the late 90s through the early 2010s. We were above that. But we are currently above anywhere we were prior to 1997. So, again, it is challenging to afford a new home today for people, and I would consider today's market more favorable to renters on a national basis than I would to buyers of real estate. That has to do with what we've built over the last few years. But I'm not sure I'm willing to buy into the idea that in the aggregate, homeownership is more difficult than it was in American history, because the rate of homeownership today is above where it was for most of U.S. history.
Yes, but I'll make the point, don't mistake a stock with a flow. In that when we look at the vast majority of those people who own those homes,
they bought them 10
they
years ago.
haven't been able to buy in the last 3 years.
Agreed.
First-time home buyers are 20 to 30% of home purchasers now.
Yep.
Given the total pool of housing that's out there, it's probably 2 to 4% of that ownership is people who were able to buy recently. So
100% I agree that housing is unaffordable for new people. I could not buy my home today in the neighborhood in which I live.
Not a chance.
I fully recognize it is very unaffordable. And like I said, interestingly, in the same places where home sales are increasing, pricing is falling, you've also seen a ton of building go to places like Austin, Texas, Nashville, Tennessee, these very popular places to move to over the last few years. You are getting offers of free rent. You're getting all sorts of different deals because they built a lot of housing in there. It's just not single-family residences by and large, but in large swaths of the country, it is becoming a real upper hand for renters in some places.
Let's take a quick break. When we come back, we're joined by Paul LaMonica from Barron's right after this.
Stay informed and prepared for market changes and breaking business news. The Financial Exchange is live every day on YouTube. Tune in, subscribe, and keep up to date on all of our show's content on a daily basis. This is the Financial Exchange Radio Network. Estate planning isn't just about writing a will. The right trust can help your family avoid probate, protect your home, reduce estate taxes, and even help shield assets from the cost of long-term care. That's why Cushing & Dolan created a new guide called Demystifying the Top 8 Estate Planning Trusts. Inside, you'll learn the difference between revocable and irrevocable trusts, why some trusts are designed to protect assets from a nursing home, and how certain trusts can keep your family's affairs private. The guide also explains some of the biggest mistakes families make, including creating trusts but never properly funding them. If you've been putting off estate planning, this guide is a great place to start. Call Cushing & Dolan today at 866-848-5699 to get your free copy. That's 866-848-5699 or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck from the Armstrong Advisory Group. Our new guide, Understanding RMDs, explains why required minimum distributions are about more than just withdrawing money from a retirement account. The rules can get complicated fast. An inherited IRA opens up an entirely new set of deadlines with rules to follow, and mistakes can be costly. The IRS can impose a penalty of up to 25% of the amount that should have been distributed. But there also may be opportunities to plan ahead. The guide covers strategies like qualified charitable distributions, reinvesting RMDs, and ways to help manage future tax exposure. To request your free copy, call us today at 800-393-4001. That's 800-393-4001, or request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Our Senators Edward Markey and Elizabeth Warren and Representative Ayanna Pressley are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Ladies and gentlemen, the weekend.
As promised, we're now joined by Mr. Paul Monica of Barron's, here to talk a little bit about some stuff. Paul, how you doing today? I'm a little disappointed we're not getting you live from the Knicks parade.
Yes, I know. I'm working from home today. It's probably going to be a little bit too crazy for me in the city today, but I do have it on in the background, watching it on TV.
Was that you I saw with the guy who had the cone land on his head, the traffic cone?
That was not me. No, I was, pretty tame in my celebration.
That's fair. Might be my favorite video that I've seen in sports celebrations this year, which is wild given all the World Cup stuff going on also. But
it is true. That's also making the city even more crowded. I know you guys are experiencing that too.
Yes, we have. We've actually had a petition up here in New England to rename the region West Scotland, and so we'll see if that ends up taking hold.
Nice.
In any case, SpaceX, their IPO is come and gone. We've got two more big ones on deck, OpenAI and Anthropic, but obviously people are like itching to be able to own the companies before they go public. What types of choices are available on public markets for people right now?
Yeah, it's a great question. Similar to what happened with SpaceX, there are some ETFs that already have private share exposure to these two AI giants. Obviously, OpenAI, known for ChatGPT, and Anthropic for Claude. Two ETFs in particular that are compelling is they actually own both of those companies. There's the iShares AI Innovation and Tech Active ETF. I know that's a mouthful. The ticker is BAI. And then there's the T. Rowe Price Technology ETF. The ticker on that one is TTEQ. They have small stakes in both companies. They make up about 1% of the fund's assets for each of them. So, not a substantial amount of money in those companies, but it does give you some exposure. And those funds have done extremely well this year because they are riding the AI wave in, more than just those companies. Both of those funds have big positions in chip companies that are surging this year. So think of Taiwan Semi and AMD, Intel, SK Hynix. So both of those funds are surging probably more because of their AI chip investments, but it doesn't hurt that they also have stakes in OpenAI and Anthropic.
So given the relatively small stakes that are in, each of the funds that you mentioned, it's you got to buy a lot of them in order to get the amount of these companies that you want, and then you're stuck with everything else that the fund has, which may or may not be a good thing.
Yeah, I think that's a great point, because if you look at some of the other funds, there are some ARK funds, Kathy Wood's company that owns OpenAI. There are 3 ETFs that have exposure, but those funds haven't done as well because some of the other investments have been hurt. There's a blockchain fintech ETF that owns OpenAI, but that's been dragged down by Coinbase and Robinhood, because of some of the volatility in cryptocurrencies. There's some other funds that have done better, though. Alger, another big investment firm, has Anthropic in a couple of ETFs, and those AI-related and tech-related funds are doing much better. They're up about 20 to 25% this year.
And what are we looking at in terms of timeline for both of these IPOs? I know there's still a little ways off, but expectations are sometime this summer. Is that right?
I mean, summer to fall seems reasonable if you look at the SpaceX timeline. I mean, SpaceX, filed, its confidential IPO a few months before we got to see the actual real quote unquote paperwork that details the financials, because that's the case that we're in right now with both Anthropic and OpenAI. They've filed confidentially, so the IPOs are coming, but investors have to wait a little bit to see what the fundamentals really look like. How much revenue did they generate last year and maybe the first quarter of this year? What are the losses like? Because both of those companies are expected to be still losing money for a bit. So I think these are 2 companies that investors are very excited about, and SpaceX successful launch, if you will, for its IPO, probably is a good sign for those 2 companies as well.
All right, Paul, I appreciate you joining us today. I hope you have a great rest of the week. I hope you enjoy the parade, and we'll catch up with you soon.
Yep, thanks a lot. Hope you guys have a good long weekend as well.
That is Paul LaMonica from Barron's, who just joined us. What do you got for me, Mike?
There's this piece today from Bloomberg about Gen Z traders who are going for broke in pursuit of a new American dream. And the piece follows along of some other stuff that we've highlighted and the increasing gambling-like nature of markets these days and what I perceive to be a confusion between investing and gambling, which is all well and good and interesting. But there's one point that I just want to make with this article. I'm going to call him Lucky, was 16 years old, and his last name is pronounced spelled Lukhey. So I'm going to go Lucky there.
Sure.
16 years old and working a part-time job at a gas station when he opened his first brokerage account under his mom's name. Don't let your 16-year-old do this. Is just the main point that I wanted to make here. And here's what people I think might fail to understand. Let's say you do that and the kid funds it with their own money. You might think that the worst that can happen is they lose all of their money. That's not the worst that can happen.
No.
You can go negative. You can get sued by the brokerage account for trading improperly. You are not allowed to legally open a brokerage account in your own name personally until you are 18 years old. All of these custodians have teen accounts and new things to try and teach young people how to invest, but you're required to actually oversee it as an adult. Don't let your kid do this. Please, you can really actually hurt yourself, your credit score, your own financial well-being if you allow for a minor to act on your behalf in financial markets. So really, 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 really don't do that.
Mike, are you familiar with Newbird AI?
Sure am. Yeah, the former footwear company turned AI builder.
Yes. So last month, Allbirds, the company that made shoes, which admittedly, I had a couple pairs of these things,
sure,
back in the day. I still have
Knew
one
their
that's,
stuff about
that's hanging
shoes
around, and they made shoes that were kind of trendy. They were really comfortable. They were made out of wool. It was fun. It was nice. It was great. but unfortunately they couldn't really make any money on their shoes, which was problematic. So they decided in April, hey, we're going to change our business model. We're going to stop selling shoes, and instead we're going to start buying servers and renting out the space and change our name to Newbird AI. Well, they just changed their name again for the second time in 2 months. Now they're calling themselves Smartbird, which is better than Dumbbird, but it's still dumb. We're going to take a break for the rest of the day and think of some new names for the show, and you'll see what we're called next time on the Financial Exchange.